Let's move on to the balance sheet now. Starting here in cell C12, let's then deal with cash and cash equivalents. The formula for that is going to be equals previous plus, then from the statement of cash flows out into 2016 that is, we're going to add on increase or decrease in cash. Accounts receivable is going to be equals to 2016 total sales of 210 million divided by then off the assumptions page the 365 days multiplied then by the days receivable. Inventories will use the same approach in so much as in this previous line what we attempted to do was say for our sales, let's assume they are all on credit. Let's assume then we have a certain amount of sales per day, and then let's multiply that by the number of days that it takes us to receive payments for those outstanding receivables, and that should approximate what our accounts receivable balance is at any point in time during the year. Same thing will hold true for inventories then. The formula will be equals, go back up to total sales, divide that then by 365 days, and multiply that by the number of days in inventory. Other current assets is going to be a simple, straightforward percent of sales analysis. So equals, we go back to our income statement, total sales, multiplied then by our estimate for other current assets as a percent of sales. And we somehow ended up with a goofy number. Let's try that again. Equals the 210 multiplied by then the other current assets as a percent of sales. All right, there we go. Total current assets will just be the sum of those that are up above. Why does it not love me? Equals sum these. Okay, there we have it. Property, plant, and equipment is going to be a little bit different. What we're going to do is take a look at all the factors involved in capital expenditures in addition to depreciation. So watch carefully. It's going to be equals the previous year. Then we're going to go out to our assumptions page, and in our statement of cash flow assumptions, let's look down here, sorry for all the scrolling around, at the amount of investing activity that's going to take place, called total CapEx. I'm sorry, but when I use this screencast-o-matic, it slows things down. So total CapEx is going to be the amount of capital acquisitions that we have, less the amount of... Let's just start that over. This is hard when you're recording this thing, so bear with me. It doesn't give me the ability to edit and go back. Ready? Equals property, plant, and equipment plus back to our assumptions page, total CapEx. So that would be how much property, plant, and equipment do we have after we've added new acquisitions, after we've sold other acquisitions, and then from there we're going to subtract off total depreciation. Intangible assets next, net is just going to be equal to the intangible assets minus then from the assumptions page the amount of current amortization. So our total assets will be equal to the total current assets plus the sum of these other two previous, and that will be the amount of our total assets. Noting that we haven't properly fixed the cash projection yet because we haven't finished the statement of cash flows. Okay, accounts payable is going to work similarly to the ways that we did our inventories and receivables. But instead of being based off of sales in this case, it will be based off of cost of sales because that's the number that represents the purchases that we make for the inputs for our products. So it's going to be equals to, we go then to our line for total cost of sales. We divide that off the assumptions page by 365, and we multiply that then by the amount of our days payable. Accrued liabilities is going to be a basic percent of sales analysis. So it's going to be equals our total sales multiplied by then, back to our assumptions page then, accrued liabilities as a percent of net sales. Other current liabilities will be the same in terms of we will reference total sales and we will multiply that then by the assumption for the amount of other liabilities as a percent of net sales. That will give us then our total. Where am I not liking that? Alt HUS. It's got those three lines, 22, 23, 24. There we go. 53 million. Now, long-term debt is going to be equals plus changes that we assume to make from the assumptions page. So it's going to be equals our long-term debt plus then, if we go back to the assumptions page, what we're going to see is there's a whole bunch of financing activity that could take place. For example, we might borrow specifically for CapEx, we might pay back, we might specifically pay back for CapEx. All those things have been properly accounted for and added onto my assumptions page. So we're just going to go ahead and add in net change in long-term debt. Shareholders' equity. Now for shareholders' equity, we're going to take advantage of the basic accounting flow, and we're going to say that shareholders' equity is equal to the previous year, add in any net income, and then subtract off any amounts of dividends. So equals previous year plus off of our income statement the amount of projected net income minus off of our assumptions the amount of total dividends that we would pay. So total liabilities and shareholders' equity will be the sum of these three figures. And we can see right now we've got a basic problem that our balance, I'm going to delete this, or copy this, we can see that we have a basic issue where we're trying to check and see whether or not these two numbers are equal to one another. And we see we've got a problem that exists. So we're going to need to correct that. And that will happen once we go ahead and properly complete the statement of cash flows.